Hello everyone, I am Michael Ruger. I am the managing partner of Greenbush Financial Group. Big market news this weekend. Trump plans to roll out tariffs against Canada, Mexico, and China. It's got investors very nervous. A lot of emails from clients asking if we should be moving to cash. But I remind clients that we've already seen this Trump tariff playbook before. He did this back in his first presidential term between 2017 and 2020. But people forget the market's reaction, both short-term and long-term, to the tariffs during his first term. So in this video, we're going to go back and look at how did the market react to tariffs during his first term, and could that give us an indication on how the market might behave with this new round of tariffs, also realizing that the magnitude of the tariffs are different, the countries that are being implemented against are different, and should clients be making any changes in their investment portfolios in response? We'll start off by going back to look at the stock market's reaction to the Trump tariffs during his first term, which was 2017 to 2020. So in 2018, he started to roll out his first round of tariffs, which were against Canada, Mexico, and the European Union, and he had issued tariffs against solar panels, washing machines, steel, and aluminum throughout the year. Also, in the final 3 years of his term, from 2018 to 2020, he was in the famous trade wars between China, which were tariffs going back and forth, escalating and de-escalating over that 3-year period. But how did the stock market react to the announcement of the tariffs? Similar today? Not good. Every time those tariffs were announced, there were sharp sell-offs in the stock market. But when you look at the total return for the S&P 500 each year during Trump's first presidential term, when he was implementing these tariffs, here are the results. So for 2017, his first year, the S&P 500 index was up 21.9%. In 2018, it was down 4.4%. In 2019, it was up 31.74%, and in 2020 the S&P 500 was up 18.38%. So if we are looking at history as a guide, it created the same height levels of volatility that we're seeing even today with the announcement of the tariffs. There were certain industries that were definitely harmed over others, depending on the type of products and goods that were being tariffed coming into the country. There were higher prices from the tariffs, but overall, the U.S. economy was able to absorb the impact of those tariffs and over time move higher. While that could be a positive sign for the markets, we also have to look at the magnitude of the tariffs that were just issued in 2025 versus the tariffs that were issued back in Trump's first term. And the magnitude of the current tariffs arguably are much larger, because while he was strategic during his first term saying these type of products or these type of materials from these countries, the tariffs that he just announced were more broad and sweeping, saying all goods from Canada have the 25% tariff with exception of oil. All goods from Mexico have the 25% tariff, so it could impact the price of more goods. Now, while larger tariffs seem like a huge risk to the stock market and the economy, we also have to look back at his first term and realize when he announced tariffs the first time, a lot of those tariffs actually never ended up going into place. And some of those tariffs that went into place, by the time they got implemented, were at a much lower percentage than he first threatened out of the gates. He uses this as a negotiation tool. So it's tough sitting here today knowing that these were just announced this weekend to know, one, at what magnitude are they going to go into place and how long are they going to be in existence, or eventually are they going to be negotiated out and either lowered or done away completely in the next few months. The reason why Trump uses tariffs as a negotiation tool is he realizes the United States has an unfair advantage in this equation because we are the largest consumer economy in the world, which means all these different countries want to import stuff that we buy here in the US. And if you make those goods more expensive, the consumer will, one, either buy less of them, or they will go to other goods that are not being sold by these countries that are importing into our country. So while the US consumer might feel pain from paying some of these higher prices, the pain is felt 3 or 5x more by these countries that are no longer importing as many goods into the US. This is all to say that investors have to be very careful and avoid making knee-jerk reactions to the news about tariffs that came out this weekend, because there's opposing forces right now that could lead to two very different outcomes. So on the positive side, if the stock market and economy will react very similar to what tariffs did in his first term, yep, there's tons of negative volatility out of the gates when these things are announced, but if the economy is strong enough, then it could absorb those tariffs and continue to grow. The other side of that argument is the US economy strong enough to absorb these larger tariffs, more widespread tariffs this time, as well as the various industries that are going to get hurt by the tariffs? Can we withstand that, as well as the retaliatory tariffs that could come from these countries that we put the tariffs on them? I think as investors hear more and more about these tariffs in coming days, you're going to hear the word could a lot. This could happen, or that could happen, or this happened in history, so this could be the path, or the magnitude is larger, so this could happen this time. Any time in the investment industry where we hear the word could a lot, it means we don't have enough data yet to make an informed investment decision. Over the next few days and weeks, we'll hopefully get more data to say, how are these tariffs actually going to impact the economy, impact the US consumer, and what path is that going to send the US economy or stock market on? And then we can make prudent investment decisions around that new data. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.